So because our cooperative wants to make long-term patient investments, we need our members to be willing to think long-term and to be patient. So the liquidity is low. And I think this is what a lot of fund managers run into, is that pressure that most investors want liquidity. All things being equal, I want liquidity. But I think liquidity is overrated. You don't need maximum liquidity for your entire portfolio. It's okay for some of your portfolio to be long-term. It's even good for your portfolio to have a portion of it be thinking very, very long-term and to not be liquid. So I think that's an interesting topic in and of itself, is the importance of liquidity and for what percentage of your portfolio. But I think liquidity is overrated.
Welcome to the Regenerative Real Estate Podcast, a show about human environments and how they can be used as a force for good. Conversations that educate and inspire people looking for a different way to do real estate. I'm Neal Collins, and on this episode, I'm joined by Blake Jones, the founder and president of the Kachuwa Impact Fund, one of the few cooperative investment funds that exist in the world. I originally heard about Blake Jones in 2011 when I was in graduate school. I was enrolled in a social entrepreneurship class, and we were learning about a new corporate certification called a B Corp. The goal of the certification is to differentiate companies that have achieved high social and environmental performance. At the time, one of the companies that had just received their B Corp certification was a Colorado firm named Namaste Solar. Namaste stuck out to me because not only were they one of the early solar companies, but they were structured as an employee-owned cooperative, and they had seen tremendous growth under this corporate structure. Blake Jones was a co-founder and the CEO of Namaste Solar for many years, and as you'll soon hear, continued his entrepreneurial journey, taking the market insights and cooperative structure he learned at Namaste to new ventures. These included a purchasing cooperative, a credit union, and more recently, one of the country's only cooperatively owned real estate investment funds. Stemming from the fable Tortoise and the Hare, where slow and steady wins the race, Blake decided to name the fund Kachuwa, which means tortoise in Nepali, where he had spent several years in Nepal as his home. The Kachuwa Impact Fund is unique in several ways. Namely, its collective ownership. This is different than a more conventional fund structure where investors make up limited partners. The second thing that makes Kachuwa unique is their mission towards impact real estate. The fund will only invest in real estate that enables a positive impact on society and the environment. And lastly, the fund isn't bounded by investing solely into real estate. They're structured in a way that allows them to originate either equity investments or debt loans to companies and organizations that are mission aligned towards impact. This was a fascinating conversation, and one I certainly hope will spark curiosity and seed new investment structures into the world. Enjoy. Well, Blake, I'm actually pretty excited to have you on. I actually know your name as kind of the initial darling of the B Corp movement with Namaste Solar. And I know that we're orienting towards what you've been up to lately, but it's kind of hard to miss out on a couple different, what seems like unique and relevant professional experiences that you've had since then. But I'd love to dial back the clock here as we start things off with who you are and where you came from. Like, how did you end up really getting interested in the impact sector and your background?
Yeah, thanks for asking. So I started my career as an engineer in the oil and gas industry, actually, and really was enamored with the oil and gas industry at the time. But I had an environmentalist for an older brother who really helped me to gain more awareness for the industry that I was working in. And that passion for oil and gas translated into a passion for renewable energy. And so I got into renewable energy almost 25 years ago and really enjoyed that. Worked in Nepal for many years with renewable energy, and then came back to the United States in 2004. And that was right when kind of the solar market was really starting to take off in the United States. And I and two others, we started a solar company called Namaste Solar that we really wanted it to be different than a conventional business and run it differently. It was 100% employee owned, democratically managed, transparent salaries. Everybody knew each other's salaries. It was a really fun experience. And we later converted to an employee owned cooperative. We just didn't know what cooperatives were when we started the company. We were naive first time entrepreneurs. But when the B Corp movement came along, we thought, oh, we're perfect for that. We want to join that. We learned a lot from other certified B corporations. We learned a lot from cooperatives. But in order for us to run the company the way we wanted to run it, we were unable to accept external capital until we found out about impact investors. When we found out about impact investing and impact investors, they wanted to invest in us because of who we were, because of what we were doing, because of how we were doing things, democratically as a cooperative. We were pleasantly surprised and were able to bring on external capital to help our cooperative grow. So now Namaste Solar is about 20 years old. We've benefited from $5 million in investment from external investors, but the cooperative is around 250 people, and it's democratically governed by the employee owners. So we've been able to do things the way we wanted to do them because of impact investors, and that really planted the seed for so many things that were going to come afterwards.
And so, yeah, let's keep going from there because it sounds like you then were able to really read the marketplace and find some different opportunities there.
Yeah. So out of Namaste Solar, we just became very enthusiastic about the cooperative model. We spun out other cooperative entities. One of them was a purchasing cooperative called Amicus Solar Cooperative. One was a credit union called Clean Energy Credit Union. We spun out a labor sharing cooperative. And also we spun out an impact investing cooperative called Kachuwa Impact Fund. Kachuwa means tortoise. So Kachuwa really started from my own personal experience as CEO of Namaste Solar. I would interview each of the impact investors who wanted to invest in Namaste Solar. And those interviews were partly just to make sure there was a good fit. But I learned a lot from those impact investors that I interviewed and was really inspired by what they were doing, really putting their money where their mouth is in terms of where they were investing, why they were investing, how they were finding opportunities to invest in. And that really inspired me and made me think that's what I should be doing with my money. And so I started to make investments with my personal money, taking them out of Wall Street and putting them into other certified B corporations that I met, through the B Corp movement. I met a lot of other employee-owned companies or companies that were converting to employee ownership that needed capital, and so I made investments there. Here in Boulder, Colorado, there are a lot of neat, socially responsible companies doing interesting things. So over time, I developed my own kind of personal portfolio of impact investments over the course of a decade or more. And as that was happening, or as that portfolio got bigger, friends and family and colleagues, when these types of discussions would come up, they would say, "Wow, you're investing in some really neat stuff. I want to invest in that kind of thing. How do I do that?" And we, would talk about how you need to be an accredited investor to invest in a lot of private offerings on Main Street. How oftentimes the minimum investment amounts are large, and so ultimately, to make a long story short, they basically asked, "Can we piggyback on what you're doing, Blake? Can we just invest alongside you in all these neat impact investment opportunities that you're finding?" And that was the impetus for Kachuwa Impact Fund getting started, where it was my personal portfolio. Then we started bringing in other people and pooling our money together to make more investments, to diversify the portfolio, and to write larger checks. And since I'm a cooperative enthusiast, we thought, can we do this as a cooperative? And there are not a lot of investment cooperatives. I think there's maybe less than a dozen that I've found in the US, but we wanted to make Kachuwa Impact Fund an investment cooperative. And fast forward to today, Kachuwa Impact Fund has around 35 million in assets, of which more than half are impact real estate, which I know we're going to talk about. And then a little less than 40% are private debt, private equity investments, all in companies that, are doing good in the world, that have impact or in accordance with what we call impact themes. Kachuwa Impact Fund has 10 impact themes. Like one of them is certified B corporations. So we like to invest in certified B corporations. And it's a very diverse portfolio with a lot of members in the cooperative that we're excited to see where it's going to go. I think it's just getting started, and there's the potential for it to do a lot more impact is tremendous.
Why do you think that there isn't more impact cooperative funds? Whenever you start to dive into the cooperative movement, Namaste Solar certainly is one of those shining examples of like, okay, this really coalesced around a time that the cooperative movement started, maybe in part because of a lot of your efforts there. But where do you see the state of the cooperative movement, particularly towards what you're doing with Kachuwa? I mean, is this the beginning of what you think more people are going to adopt, or is this still going to stay fringe and pretty small?
Yeah, that's a good question. The cooperative structure has been around for more than 100 years, and there are many different types of cooperatives. And I think when you look at those different types of cooperatives, some of them are prevalent and they're everywhere, even if we're not fully aware of them. So I'll give some examples. Like agricultural cooperatives, there are a lot of farmer-owned cooperatives. They've been around for a long time, even though we may not be fully aware. Organic Valley is a common one. Right? Sunkist. There's multiple agricultural cooperatives that are out there. Credit unions are another example. There are more than 4,000 credit unions in the United States. Those are all member-owned cooperatives. And I think you could call them a type of investment cooperative, although it's more like a depositor-owned cooperative. And they're thriving, and they've been doing what they're doing for almost 100 years, too. Then you've got rural electric cooperatives, like electric utility cooperatives, which provide the electricity for many people throughout the United States, especially in rural areas. There are hundreds, if not more than 1,000 of those. And then there are a lot of cooperatives you may not know are cooperatives like True Value Hardware and Ace Hardware. Those are purchasing cooperatives that help mom and pop hardware stores compete with the likes of Lowe's and Home Depot. And then REI, REI is a big outdoor gear cooperative that's at least well known out here in the West. So there are a lot of cooperatives out there, and some types are more ubiquitous than others. But employee-owned cooperatives, which are also called worker cooperatives, there are fewer of them. And I think that those are growing in number, partly because of awareness, partly because of some positive examples, but also because the employee ownership movement in general is growing. And cooperatives are just one type of, one structure for employee ownership. But the employee ownership movement is growing, and a big part of this baby boomers. A lot of baby boomers who own businesses are retiring, or they're going to be retiring, and they call it the silver tsunami. And there's a concerted effort to let those retiring baby boomer business owners know that you can hire a broker and use a broker to sell your business or sell to a strategic acquirer, all the normal options that people have. But there's also the option to sell to your employees, and a lot of people just don't know about that there are tax advantages. There are lots of positive reasons to do it, but it's gaining in popularity. So I think because employee ownership is gaining in popularity, so is employee-owned cooperatives. The investment cooperative movement, I guess we're trying to start it. It doesn't exist yet because there's only about a dozen of us, but that's what we're hoping Kachuwa Impact Fund can do. Is that I am a big believer in the power of a positive example and good case studies, and so what Kachuwa Impact Fund wants to do is demonstrate the merits of an investment cooperative structure, and over time set a positive example, because there's nothing like lends credibility to a positive example like having done it for a really long period of time. Namaste Solar now with 20 years under its belt can really be more of a positive example than it could when it was only 5 years old. So that's what we're hoping to do. So I think the cooperative movement overall is growing, but you really kind of need to look at the different types of cooperatives and what's going on with each of them. And investment cooperatives are really probably at the very beginning of their journey.
That's interesting. Well, starting Kachuwa, it's got to be very different than making investments in your own portfolio, because now you've got to come up with a thesis, you've got to put together a board, you've got to understand how voting works. What is that process like as you are really starting to get those calls of, I want to make similar investments and I want to align my values with my portfolio? How do you begin to structure Kachuwa so that it can have legs and success as a growing cooperative?
I definitely benefited from having started multiple cooperatives before this, so intimately familiar with cooperative structure. Knew about starting companies, and knew about making investments on my own, particularly in real estate, but also in private equity, private debt. And then I did a lot of research, just learning a lot about other funds and how they're structured. So, and then also bringing in a team of people that had different backgrounds and experience. We have some former venture capitalists, for example, who knew that space really well, but they brought to the table all the things that they had learned and ways that they liked doing things, but also, they learned ways that they don't want to do it anymore. So they brought a lot of that to the table. We had multiple operators, entrepreneurs on our team. So that also just helped us to be empathetic with the entrepreneurs and the companies we were investing in, what it's like to operate a company. So I think doing it as a team brought a wealth of experience and knowledge to the table. And then we started small and slowly, and not trying to swing for the fences or do too much at one time. But Kachuwa has gradually grown and learned and expanded. And then the members that join the cooperative also bring their expertise to the table. And in general, I'd say the members of our cooperative are more engaged than the average limited partner or LP in a fund. And so we benefit a lot from everybody who joins the cooperative too. So it's kind of been a gradually snowballing effort, but I think we've got a really good model and a really good template, and we're excited for other folks to learn about it.
I know that you've got a percentage that you're invested in companies and a percentage that's invested in real assets. What was the original thesis with that? And did you have an idea of, like, these are the kinds of companies or properties that you wanted the fund to purchase, or was it more opportunistic?
Yeah, part of it was opportunistic in that I helped to buy the real estate that Namaste Solar needed as it was growing. And the cooperative wasn't able to afford real estate on its own. We didn't have enough capital. I had done well in the oil and gas industry before and had capital, and the bank that was willing to provide a mortgage said, we're really not going to be lending to the cooperative. We're considering ourselves lending to Blake, and he's got personal assets and a personal guarantee that he can be providing. And because we wanted to do things as a cooperative and I didn't want to have outsized ownership of that cooperative, we decided to split it so that Blake would be purchasing the commercial building and then renting it to the cooperative. And that was one of the first assets in the cooperative portfolio, or what later became Kachuwa's portfolio. So I think some of it was opportunistic, just learning about real estate, and that there are actually a lot of impact companies that need help with gaining control of their real estate destiny, just as much as they might need access to debt or, mission-aligned capital. And so since then, we've learned there are a lot of companies out there. They don't necessarily want capital investment, or they don't want a loan. They want help buying a building to gain control of their real estate destiny. And so some of it is opportunistic in that regard. Some of it's also regulatory, that because Kachuwa, first and foremost, is actually a real estate company. We predominantly operate real estate. We are not regulated like an investment fund under the Investment Act of 1940. So we're not a mutual fund. We're not even considered a private equity fund. We are a real estate company that also does side investments with less than 40% of our assets. And that it's just easier to manage the fund because of that, or to manage the cooperative. So some of it was regulatory reasons. And then third, we found that there are wonderful benefits to having real estate in your portfolio. I'm sure a lot of your listeners understand that the cooperative's portfolio is way more diversified for the benefit of all the members, because it has a nice mix of real assets, but also other asset classes like private equity and private debt. And that kind of having the majority, the meat and potatoes, the ballast, be real assets that generate great cash flow, where we can also, we're expecting appreciation in values, and that are just have a lot less risk or a different profile than a lot of the private equity and private debt investments we make, was a wonderful advantage. So I think there were multiple reasons why we wanted to have the cooperative be at least 60% real assets.
Let's hone in on the private equity and the private debt side, because this is a really interesting structure. Like a lot of real estate funds, they're 100% in real estate, and they'll develop a thesis and they'll go after that. It's unusual to even have different asset types in a lot of funds, but it's got the feel of a mutual fund in a sense. What kind of companies would you place investments on the private debt and the private equity side?
Yep. So, yeah, and it's interesting what you said. We often refer to Kachuwa Impact Fund as kind of a cross between a REIT and a mutual fund, but it invests in Main Street instead of Wall Street, and it invests with impact. But the first thing we look at when we look at impact companies to invest in is we look at alignment with our impact themes. We have 10 impact themes. One example I gave earlier is certified B corporations. Another impact theme is cooperatives. Another one are companies that are majority owned by women, BIPOC. Another impact theme is renewable energy and energy efficiency. So there's multiple impact themes, and we look for alignment with at least one of those, ideally two or three. Like we love seeing a woman-founded company that is a certified B Corp and also does business in renewable energy. We would call that a triple word score because it's aligned with three of our impact themes. That's the first thing we look at. And then the next thing we look at are a lot of the things that normal investors might look at. What market are they in? What do they need the money for? What's the risk reward profile? And so I think impact comes first. And the members of our cooperative know that. We're primarily impact driven, we're not seeking to maximize financial return at all costs. We're seeking, instead of an extractive return, we're seeking a very reasonable financial return while also having very, very high impact. And so trying to find good balance between the two, but prioritizing impact. And then we look for diversification too. So for example, of the non-real estate portion of our portfolio, we won't invest more than 30% of that in startups, in companies that are pre-revenue or haven't been around for more than 5 years. When you look at a lot of the companies we're invested in, they've been around for 30 or 40 years, which is really interesting that there are a lot of companies that are around for a really long time that need investment capital, but they don't want to sell the company. They don't want to sell to private equity or usual suspects and lose control of their company because they want to keep running that company either as an employee-owned company or owned by a perpetual purpose trust, and they need mission-aligned capital to do so. So we look for a lot of different things, but one of the biggest is diversification, and the biggest is impact alignment.
Just speaking from my own personal experience, like that is such a welcome message, because as I've gone out to the capital markets as a startup, the venture money out there, it's almost gotten conflated with tech, where they're looking for that hockey stick growth. And whenever you mention private equity, it's almost synonymous with you're going to be out in 3, 5, maybe 10-year cycle. And that might be a stretch, Yep. And you're just going from startup to seed to Series A to Series B, and then what's the path to going public? And it's a pretty demoralizing path to raise money for a business idea that you're incubating.
That's exactly right. So part of the goal is to provide mission-aligned, patient, and non-controlling capital so that there can be more impact companies out there that don't feel that pressure of when they take money, they've got to grow faster than they otherwise would want to. And they've got to provide a liquidity event. They've got to provide an exit within the next 10 years. That kind of pressure for an entrepreneur or for any company, it changes the way you do business. And that might mean that you're not able to run the company the way that you want to and pursue the mission the way that you want to, and maybe not have as much impact as you would otherwise want to. So we want to be a source of capital that can help allow more of those companies to exist and to thrive. And then hopefully by encouraging others to invest the way that we do, it'll create a broader ecosystem so that there are more capital providers for those types of companies to find, so that they don't have to get pigeonholed or railroaded down the normal path if they take money from the usual suspects, the venture capital funds or private equity funds or just angel investors who are looking for those same things. So that's a big part of it, is we're willing to invest for a very long period of time, decades, We do not need a controlling stake. We don't want to exert control over you. As long as you're pursuing your mission and you're having impact, great. And we don't need extractive returns. So that's a big thing I think that the ecosystem needs. And then the other part of it is we're trying to provide for our members an alternative to Wall Street, a high impact alternative to Wall Street that provides the diversification of, that cross between a REIT and a mutual fund, all high impact off of Wall Street. That's very appealing to a lot of folks like myself. That's what I was always looking for. I couldn't find it. So I kind of had to put that kind of portfolio together myself. And then all the members of the cooperative are looking for something similar. So we're trying to solve two problems. And what's nice is that we can do that, at the same time with what Kachuwa is doing.
I want to talk about those members, but in the framing of the investment theses I see from fund managers where, and I don't want to put words, it's my job to put words to this, but this is my theory, which is they end up in creating these fund structures for accredited investors on these shorter private equity cycles because they're trying to stay competitive in the marketplace to go out and raise money. And so just by nature, they're going in this direction of being more extractive, having shorter cycles, really looking for those unicorns. How do you even find investors that want to be mission aligned like that can have really patient capital? That are they saying, look, I'm okay with taking a concessionary return, or are they indexing? I would imagine they're indexing the impact just as high as the financial return. Like, can you paint more of a vivid picture around how they're making these decisions and how they're finding you, things like that?
Yeah. I think the profile of our cooperative member, that they're all different. And I'd say the same thing with impact investing in general. I think sometimes the impact investing world kind of differentiates between folks who are impact first and those who are financial return first. And there's a very healthy debate going on there. Like, do you have to sacrifice financial return in order to achieve impact? But what we've tried to do is just set expectations for, like, we have a very diversified portfolio. And, sometimes we make investments in CDFIs, community development financial institutions, where we might lend money for, only 2 or 3%. And at the other end of the spectrum, we have real estate projects that might be providing, double-digit IRRs, or we might even invest in some venture capital funds, some high-impact venture capital funds that provide high returns. And then we have everything in between. So it's a very blended portfolio with blended risk reward profile. And we're saying there's strength in that diversification. And here's a return we're aiming for. But please know that impact is our number one priority. And achieving a reasonable financial return is a secondary priority. We think it's just very helpful to set expectations that way, because setting expectations and managing expectations is one of the most important things if you're going to manage a fund. But I think maybe, unfortunately, if you start a fund where you're advertising, I'm going to provide liquidity and this type of double-digit return, you've kind of already set yourself down that path, and you're only going to be attracting investors who want that. And for you to change course, that would be really difficult. So a big part of it was just setting those expectations from the get-go. But yeah, it's interesting. Once you start meeting impact investors or the types of people who are members of our cooperative, it's fascinating. There are a lot of people out there who would like to have some reasonable balance between impact and financial return. And the more that you go to, their impact investing conferences, you'll meet more of them. And so I think that's a big part of my journey, was I started meeting them at Namaste Solar, and then I started meeting them at B Corp conferences, and I started meeting them in the employee ownership world, and then started meeting them through Kachuwa. Then there's a whole group of impact investment advisors, registered investment advisors, who are now providing that for their clients. And I think some of it were some of the early investment advisors were saying, here are the types of things that we can help you to invest in, and that it attracted a certain type of client. But now there are more and more clients who are saying, we want more of this type of investment. And they're encouraging their investment advisors to start saying, oh, wait, my clients are asking for this. I need to find investment opportunities for them that meet their impact goals. So all these things are positive trends.
What is the line between accredited and non-accredited for Kachuwa?
We don't have one. So our members are both accredited and non-accredited. And with the type of private offering exemptions that we utilize, yeah, we're open to accredited and non-accredited investors.
The direction that I'm going in here is, some funds, they're even impact funds. It's like they're trying to go after institutional money because they think that's where the most, like, the catalytic moment in investing can be. Let's steer more institutional capital, larger amounts of capital into the impact space.
More dollars, more scale.
Yeah, exactly. Versus if you're going with non-accredited, you're saying we don't need the institutions right now. We're going to go work with individuals, whether they're accredited or non-accredited, where the conventional industry is just going to see that as less efficient at raising capital.
Yeah, I think an argument can be made that it's less efficient. I think in our case, we're taking an all the above approach. So we'll take institutional money from accredited investors and money from non-accredited investors. And part of our goal, though, is to help more people invest in private impact real estate, private impact companies, and making that possible. Because those private impact companies, they need more capital from mission aligned folks. And it's difficult for individuals to meet the investment minimums, or they may not even be able to participate and invest in that company if they're not accredited. So I think having, a vehicle like an investment cooperative for them to be able to do that and to do it in a diversified way, right? Even if you could meet the minimum and the minimum is $25,000, a non-accredited investor might be putting too many eggs in one basket to invest in that, impact company that they really want to invest in. But in a similar way that a lot of non-accredited investors like to invest in mutual funds because of the diversification that they offer, we want to provide that exact same thing, but for on Main Street with impact.
Because you're blending the REIT structure with the mutual fund structure, how liquid is a member's share?
Yeah.
Are they able to easily pull the money out, or
no, they're not?
Is there a term limit?
Yep. So because our cooperative wants to make long-term patient investments, we need our members to be willing to think long-term and to be patient. So the liquidity is low. And I think this is what a lot of fund managers run into, is that pressure that most investors want liquidity. All things being equal, I want liquidity. But I think liquidity is overrated. You don't need maximum liquidity for your entire portfolio. It's okay for some of your portfolio to be long-term. It's even good for your portfolio to have a portion of it be thinking very, very long-term and to not be liquid. So I think that's an interesting topic in and of itself, is the importance of liquidity and for what percentage of your portfolio. But I think liquidity is overrated.
That's really interesting to think about. And this is where I quickly run out of runway in my understanding of cooperatives. But let's say somebody comes with $10,000 and another person comes in with $1 million into the investment fund. How do you weight decision making? Is there a weight towards the people that have more shares?
Yep. So that's the hallmark of a cooperative, is their decision-making contribution would be the same. It would be equal. And in this case, it's just at the stockholder level. So someone who invests $1 million, someone who invests $10,000, they're both going to get a proportional financial return or similar financial return, but they're each going to just have one vote. And what our cooperative votes on is primarily the board of directors. Members are not voting on what we invest in. So it's really at a stockholder level that we're talking about democratic governance. But that's the hallmark of a cooperative, is democracy at the stockholder level. And then our board of directors, which right now doubles as our investment committee, we're the ones making investment decisions. But in any democracy, that healthy check and balances, our board has a fiduciary duty to all of our members. Our members vote on the board of directors on a one member, one vote basis, not based on the amount that you've invested. So, but that's a big part of what makes us a cooperative.
Before we continue this episode, I want to talk about the tremendous potential embedded within the real estate industry to create life-giving communities and thriving habitats. The hard part, though, is that development is complex and requires specialized knowledge around design, planning, capital and investment, community engagement, and construction. That's why at Latitude Regenerative Real Estate, our work goes to serve those that seek to create projects that strengthen communities and develop ecological resilience. We work with developers and landowners to bring purpose-driven projects to life. So when you are ready to leave a legacy and need an experienced team that knows how to create successful projects, I encourage you to reach out to us by visiting our website at chooselatitude.com. Because this is a real estate show, Blake, I want to get into the real estate side of the portfolio, that the larger stake that you've got right now. What kind of real assets have you invested in? Do you see more potential there around the real estate sector? I'm curious your thoughts on that.
Yeah, primarily commercial real estate. And we just made our first two investments in affordable housing. So 2 affordable housing apartment complexes with about 35 units each in Portland, Oregon, through a firm called Short Stack. Those are our first 2 investments in affordable housing, and our members are really excited about that. And we made those investments about 1 to 2 years ago, and both of those apartment complexes are under construction right now. Before that, it was all commercial real estate. And the way that we would source our deals is that a nonprofit or an impact company would come to us and say, we need help gaining control of our real estate destiny. We've found the perfect building that we want to buy, but we don't have the capital to do so. Can you help us? Or impact companies will come to us and say, we love our current home, but it's about to be sold out from underneath us. And if it's sold, it's going to be developed and turned into something else. Can you help us to buy the building we're currently in so that we can maintain it as our home? So that's how we find our projects. And again, this is a way to help impact companies who, yes, you can support them with loans and with equity investments, but another way you can support them is helping them gain control of their real estate destiny. So most of our projects are commercial real estate. And then what we do is when we help an impact company to buy the building, we don't just want to replicate a conventional landlord-tenant relationship. We want to be partners with them. And so we will give them equity in the building, even if they don't contribute any capital, in exchange for co-managing that building with us. Usually we'll put in place a hurdle rate, an IRR that the cooperative needs to achieve. And then above and beyond that hurdle rate, it's kind of like a partnership flip. It'll change the ownership percentages of the LLC, the special purpose entity that we create to own the building, so that it will unlock long-term ownership in the building for them if they help us to co-manage the property and after the cooperative achieves a certain hurdle rate. And so, we're big into shared ownership. A similar paradigm as like employee ownership. If you have an employee who's thinking and acting like an owner, they're going to add more value in their job role with the company day to day. Same thing with our tenant partners. If they are co-owners of that building, they're going to help us to do a better job of co-managing the building, maintaining value in it, adding value to it, taking care of it over the long run as we co-own that property together. And that model has been really exciting. It's been very successful so far, and we found it to be a win-win.
That's fascinating. It brings up this question on placing private equity or private debt. Do you ever work with companies that are transitioning to employee owned and work out the financing and originate, let's say, a mortgage for employees to buy out the owners?
Yeah, we haven't done that. And there are some impact companies out there, or a company that's transitioning to employee ownership, where they're doing a capital campaign where they want to raise equity or debt and then use that money to buy a building. And that path is fine, but that's not what our cooperative helps with. Instead, what our cooperative will do is say, we'll buy the building for you, and you can contribute capital right alongside ours if you want to, but we'll buy the building for you, and then we'll give you additional ownership in it over the long run. That's the path that we prefer to take, and that's that shared ownership model that I described earlier that we prefer to utilize, and that's what we utilize for all of our commercial buildings. Now, we haven't figured out what to do there, how to apply that to affordable housing. We do want to find some way for the tenants in the affordable housing developments to gain ownership over time, but we haven't figured that out yet. So, and I think we've got some time to get creative on it. But with commercial real estate, that's the model we like to use.
Do you ever have any performance and like either sustainability hurdles that a building has to meet?
Yes.
Anything like that?
So the first thing we look at is impact. Similar to if we're looking at an impact company to provide debt or equity to, we want to look at what's the impact of this real estate project. It could be we might want to green up the building and obtain LEED certification. And that LEED certification could be how it's operated, or it could be, associated with a remodel, or we've even done some new construction and made it LEED certified, and designed it to be LEED certified. It could be who the impact tenant is. If it's the tenant that's going to occupy the building has lots of impact, we consider that an impact real estate project. It could be where it's located. It could be in a low-income neighborhood, and we're trying to help prevent, gentrification and help an anchor tenant in that neighborhood to, that's what we're doing for a low-income neighborhood in Denver. So there's lots of different ways the real estate can have impact, but those are some examples. So that's the first thing we look at. And then usually we will get a mortgage, often from a mission-aligned lender, like a credit union or a certified B Corp bank. It's typically been less than 65% loan to value. We're providing, in most cases, 100% of the capital that's required, but sometimes the tenant does invest alongside us. Our cooperative just needs to be majority owner, and then we will, share the management and the ongoing management decision making for the building over the long run. Sometimes it will come with strings attached. If there's not enough impact when we buy the building, we will often say, okay, we're agreeing that we're going to add a solar system to the roof. We're going to add water saving features. We're going to add electric vehicle chargers, and we're going to pursue LEED certification. We've done multiple real estate projects where that was part of the agreement between us and the tenant partner when we bought the building, to make sure that those things happened so that it met our required impact thresholds for the project.
That's really interesting. Where my mind goes is, this isn't evergreen fund. Would you use those terms?
Yes.
You're making investments in there. If somebody's coming in, and this is very different than let's call it a closed-end fund, where you put your money in, you make allocations into 5 different projects, and then you manage that, and the money is returned. How do you actually allocate towards, okay, somebody comes in January of 2022 versus somebody that came in 24? You're making investments all along the way. What is that process like?
Yeah, so that's an important distinction, and thanks for bringing it up. We are very much a cooperative with an evergreen portfolio. So a member who joins the cooperative now versus a member who joins the cooperative 20 years from now, they're co-owning the same portfolio. That portfolio changes over time, but it's not like a lot of fund managers will create fund 1, fund 2, fund 3. They've all got separate portfolios, and investors invest in each of those funds. And they're like you said, they're closed end, and then they want to, liquidate all the assets in that fund and pay all the investors back and close it out, and then, start another one. Ours is very much an evergreen portfolio. And so this is another way in which we're cooperative. We utilize the cooperative principles of patronage dividends in order to provide a return to our members. With a lot of funds, it's often done in terms of a net asset valuation for the portfolio. If you invest later than another investor, maybe the stock price or the investment amount is higher to get into the fund than it was for an investor who invested earlier. But one of the problems with that is that net asset valuation, that NAV, is a highly speculative, usually very inaccurate valuation of what's the value of all these assets that are in the portfolio. And so everything in our portfolio, when we report it on our balance sheet in our audited financials, it's all at cost basis. And we actually don't spend much time trying to figure out what is the potential value of this real asset. We keep tabs on it. If we get unsolicited offers, or sometimes we'll do a broker opinion of value, we don't want to turn away from it if we get data points, but we don't spend too much time spending our time trying to figure out what is the exact value so that we can determine a share price for our fund. Instead, all of our shares are fixed price shares. When someone buys in now versus they buy in 10 years from now or 20 years from now, they're buying in at the same stock price. And we're not utilizing net asset valuation for that. So instead, what we do is we use the principles of patronage dividends, or accruing patronage, which is how cooperatives pay dividends to their members, to take into account the changes in the value of the portfolio over time. So bear with me here. When we have two types of patronage activity, one of them is annualized patronage activity. And we take a look at the types of income that we get that are predictable on an annual basis. A really good example is rental income. The leases that we have with our tenants, they're usually long-term leases. We know how much we're expecting to earn from that lease and rental income each year, right? Another one might be if we provide a loan to an impact company. We're expecting to earn this much interest this year and this much interest next year. Those are relatively known. So in any given year, we take that annualized patronage activity and we divide it up among our members based on how much they had invested in the cooperative during that year. So if you invested $1 on January 1st and I had invested $1 on July 1st, I would get one half of that portion of the income than you would, because you were invested for the entire year and I was only invested for half of the year, and we had invested the same amount, right? Very fair way to divide that up. The other category is what we call multi-year patronage. And that's where a return, it's not coming on an annual basis. It's not predictable. It's like a capital gain that you would get from selling a building after 20 years. The rental income that you get during those 20 years is more predictable because it matches what you're getting from the lease. But the capital gain only comes after owning the property for 20 years. And it's difficult to predict where that's going to be. And it's only earned over a 20-year period. So what we do is we apply the same concept, but instead of looking at pro rata over 1 year, we look at it pro rata over the 20-year timeline that we owned that asset. So as an example, if we sold a building after 20 years and we made a big capital gain, if you invested in the cooperative, you joined the cooperative in that 20th year, but I was invested and I was a member of the cooperative for all 20 years, we're not going to get the same thing. If I had invested $1 for all those 20 years, I would have $20 years of patronage. Whereas if you invested $2 in that final year, that 20th year, you would have $2 years of patronage. So I would get 10 times as much of that capital gain as you would. So it's a very mathematical, very fair way to divide up the actual income that's generated from those assets.
Well, I'm glad I asked that question. That would have kept me up at night trying to work through that. And that really tees up nicely. What is the vision for the future? What is the path of? Is it growth? Is it allocation into more assets? Like where do you really see the next 5 to 10 years? What does success look like for you?
It's rinse and repeat what we've been doing the past few years, which is to slowly, gradually grow the cooperative so that we can benefit from scale economies and so that we can diversify the portfolio, further diversify the portfolio. That's the benefit of all of our members. And so that we can scale up our impact and have more impact. So I think that we have been doing that really well. We haven't been growing too quickly. We haven't been growing too slowly. We've been adding around 40 to 60 members per year, raising around $3 to $5 million per year, and then deploying that primarily in real estate, but also in the other asset classes. So I think we'll probably expand into other asset classes. A good example is we just made our first investments in affordable housing. That may continue. Part of it is, yes, we want to continue to pursue diversification, but we also want to make sure that it's, we're able to manage those assets well. And I think if we're spread too thin and involved in too many things that require special expertise, that could be an issue. But so far, I think we've been diversifying the portfolio at a really good rate, and our members are happy with it. Our board's happy with it. So we'll continue doing that in future years. And right now we're about 35 million in total assets. We're excited to see what the cooperative would look like at 100 million in assets or more. Very diversified, multiple full-time staff. And actually, that brings up another interesting way in which we are different than a conventional fund. A conventional fund will have a third-party manager, and you'll often pay 2% of assets under management to that manager, and they might get a 20% carry. With a cooperative, we have staff, and we pay the staff's compensation, but there is no profit motive for a third-party manager. The management are employees of the cooperative. We pay expenses, the compensation expenses, and whatever the net income of the cooperative is, that's what you distribute to members. So it's that's another key difference between an investment cooperative and a conventional fund.
I would hate to not ask this as well, because Namaste Solar was so instrumental and I think catalyzing a lot more cooperatives into the world. For people that are looking to create a similar cooperative investment structure that may have a different thesis than you do, is there resources out there that they can follow? Like if there's a dozen companies like this, is anybody writing the playbook? Is there any attorneys that are really specializing in this? What does that look like?
That's a good question. There are definitely groups where you can go to find out more about cooperatives, like the National Cooperative Business Association. But then, like we talked at the beginning of the podcast about different types of cooperatives, there's also organizations like the United Federation of Worker Cooperatives, or, there's a group of purchasing cooperatives. There's multiple trade associations for credit unions. So you kind of, what type of cooperative are you looking at? But for investment cooperatives, that doesn't exist. So maybe we do need to start a group of, get that dozen or so investment cooperatives that exist and start talking so that we can help provide more information. But I think one thing you could do is, reach out to us, and we're happy to share our bylaws. We're happy to, there's multiple educational resources we can provide on how we run our investment cooperative, but there's also a lot of other good examples out there. So there's the East Bay Permanent Real Estate Cooperative. And by the way, most investment cooperatives are real estate cooperatives in that their primary asset is real estate. There's, I think, 2 or 3 that are in Minnesota. There's one in New York, but there are multiple investment cooperatives. One is called the Northeast Investment Cooperative. There's one called the Northwest Pennsylvania Investment Cooperative. There's Taproot Investment Cooperative. So I think that's a really good place to get started, is to just look at those examples of how those investment cooperatives do things. And that's probably one of the best ways to learn. But unfortunately, we need to grow the ecosystem of technical service providers and attorneys and accountants who understand how to help someone to start an investment cooperative.
Well, what a fascinating time and what an incredible opportunity that you can really provide to help grow that movement, just with everything that your professional path has led you on. Blake, this has been tremendous. I really wish you a lot of success. We'll be following along very closely on this journey. What's the best place for people to learn more about the Kachuwa Impact Fund?
You can go to our website, which is KachuwaImpactFund.com. Kachuwa is spelled Kachuwa. So KachuwaImpactFund.com. Thanks for highlighting what we're doing, Neal.
Yeah, no, it's a pleasure to actually learn more about this. There's not that many examples, as you just mentioned. And so you're the first cooperative impact investment fund that we've had on the show. I hope that there's going to be more. I think there's a lot more room to grow the pie than to have this perspective that, like, how do we just take shares of the existing impact investment pie? It's a very generative space right now. And the more opportunities out there like this that there are, I hold tremendous hope. And it's exactly why that I wanted to have you on the show.
Thanks for having me.
Yeah, it's a pleasure, Blake. Okay, that is a wrap. Thank you for tuning in to the show today. If you got any value out of this conversation, be sure to subscribe to the podcast so that you don't miss future episodes. I can honestly say that these conversations have changed my life, my business, and how I steward my own home. If you want to learn more about our work at Latitude, where we partner with property owners, developers, and stewards to create thriving communities and resilient habitats, then you can find us online at chooselatitude.com. Also, if you have a project that you are needing help bringing to life or would like to align your investment portfolio with profitable investment opportunities that benefit communities and the environment, then you can reach out to me directly at neal@chooselatitude.com, and we can start a conversation from there. Okay, that's it. Until next time, here's a friendly reminder that the water we drink falls from the heavens, the air we breathe comes from the beautiful symbiotic relationship we have with plants, the food that nourishes our bodies come from the ground we so cavalierly pave over, and that we all have a role to play to regenerate this planet.